Okay, good day, audience. First of all, tell me this the voice screen share and the video is clear. Please reply. Voice screen share and the video is clear. Okay, good. Now, yesterday we did question number three, and then we did something of IFRS 2 share-based payment. Something of IFRS 2 share-based payment. I discussed this thing that if parent company issuing shares to subsidiary company employees for the purpose of motivation so that employees work hard and work hard for the group. So this is simply in the scope of IFRS 2. This is simply in the scope of IFRS 2 because the group we are giving shares, the group shares, the group shares to group employees in return of service. So this is pure IFRS 2 and it should be recorded in the group books as share based payment, IFRS 2 equity settled share based payment. Okay, but there was one more case which I taught you yesterday. If parent company is acquiring S company and at the date of takeover, parent company is issuing shares as a consideration, to buy that company. So this shares consideration is not in the scope of IFRS 2. This is in the scope of IFRS 3. That's why you studied in FR level, because in FR level there was no IFRS 2. Okay, these two things we discussed. Now the third topic is replacement awards. This is a technical topic. Even your examiner has written article on it, right? And this has been tested 2 or 3 times. Like back in 2008 there was a question margi, and this is normally a majority teachers teaches that question margi, right? It came in that margi question, and then Leuploid, that is September or December, yes, September December 2019 attempt Leuploid. Okay, so what is this case? Try to understand. I don't have pen, but I will explain you, don't worry. See, for example, parent company buying controlling shares of S company on 1st January 22. Parent company buying controlling stake of S company on 1st January 22. Okay, now listen the story of S company. S company S company promised their own employees 4 years back. 4 years back, S company promised their own employees 4 years back that if you stay with us 4 years, we'll give you this much shares. We will get you this much shares. We'll get you this much shares. Okay, and now these 4 years are completed on 1st January 22. Now these 4 years are completed on 1st January 22. I repeat, P company wants to buy S company on 1st January 2022. This is the first part of story. Now the second part of story related to the personal life, of S company. S company 4 years back, exactly 4 years back, S company offered their own employees some share options and in return offered them to stay 4 years. So now employees stayed 4 years. That means these options are vested. That means employee has done their work. So now S company should give shares. S company should give shares to the employees. But when parent company offered this takeover deal, so S company management told parent company that we will sell you our shares, controlling shares on one condition, if you give shares to our employees as well. Means whatever shares S company had to give to their own employees, now parent company will give. This is what we called replacement awards. That means parent company will replace S company's own awards, right? Okay, so that means that the deal looks like now whatever shares parent company will give to S company, this is mandatory, obligatory, and this is the condition of S company. Otherwise S company people says, S company management says that we won't sell you, we won't sell your shares. So this replacement award looks like a compulsory thing, looks like a buying price, look like a cost of investment. So normally it is in the scope of IFRS 3. Normally it is in the scope of IFRS 3 because now parent company is giving these shares to acquire that company, otherwise as company management won't give their shares. Okay, now what is the twist in this story? For example, read this: P company buying controlling shares of S company on 1st January 2022. S company issued option to its employees 4 years ago. This is the back end of the story. Please don't sleep. With 4 years vesting target. So today that target is met and the fair value of option to be given by S company is 20 million. Now S company had to give $20 million shares to their employees. S company had to give $20 million worth of shares to their own employees. But now S company's management asked parent company to replace these awards with parent company's own shares. So this is a condition. This is a condition. So it's look like a buying price for parent company. It's look like a consideration. It looks like a buying price. But now, what parent company did? What parent company did? Parent company issued shares worth 22 million. That just think, S company asked to give shares of only 20 million to employees, but for good gesture, as there is a new takeover is going on, just to motivate employees, parent company gave 22 million shares, $22 million shares. So now there are two elements in the deal. There are two elements in this deal. If you are active, you will understand in seconds. See this. There is one element which is mandatory replacement, one element which is mandatory replacement, that is 20 million. That is 20 million, and that should be part of COI. That should be part of COI because we have parent company have to do it at any cost. This is part of COI, and this is IFRS 3. The remaining 2 million, the remaining 2 million, the remaining 2 million is voluntary. The remaining 2 million parent company gave to motivate. Just recall the old things. The remaining 2 million parent company gave to motivate the employees of S company so that they give good service to the group. Yes, this is in the scope of IFRS 2. This is in the scope of IFRS 2. So 20 million will be the part of COI. 20 million will be the part of COI, and remaining 2 million will be IFRS 2. This is IFRS 2. Now, in that question, my dear students, in that question it was also written, that parent company does not want any post combination services. Parent company said, okay, instead of 20 million we are giving you 22 million, and in return we don't want any extra services. So if you remember yesterday's class or your own classes, it looks like unconditional grant. So unconditional grant goes in PNL immediately. Unconditional grant goes in PNL immediately. But wait, as a student you may ask, sir, what if parent company asked these guys to work 2 years more? Ask these guys to work 2 years more, or is there any vesting period? So definitely you need to spread. Then you need to spread this expense over the remaining life. Okay, right? So this is the story. This is the basic story. This is the basic story. This is not Leuploid. Leuploid was more technical, because in this case I made something very simple, and that is, see, the 4 years, these 4 years are completed here. These, I said, these 4 years, these 4 years are completed here. Now, as a student, you may ask, sir, what if this 4 years has not yet completed at acquisition date? This 4 year has not yet completed on acquisition date. Then what will happen? Now, this is a separate case. This is what came in Leuploid. This was the first case as a beginner level, just to make your mind Just to make you understand, I gave this easy example which came in Margi question. Margi, right? So in this case, all 4 years gone, all 4 years passed, all 4 years passed. Okay, but there is one more case. First, tell me, did you understand 80% of it? Did you understand 80% of it? We are not 100% people, please. No more 100% in comments. We need 80, 70. Okay. Now let's go. Let's move towards the real case. Leuploid. And you know, there is one paper which is called maths. Maths never leave you. Maths never leave you. You have to understand maths. Now, see, this is the new topic. Let's read it. Some discussion. Introduction. In a business combination, that consideration paid by the acquirer for the controlling interest in the subsidiary must be recorded at the fair value of consideration given. Yes, we all know in IFRS 3 business combination, we record all consideration at fair value, right? When the parent simply pays cash for the equity interest, there are no complications. This is basic dialogue. Yes, cash, when you give cash, cash is always at its own fair value, right? So first paragraph is general discussion. However, where the subsidiary has previously issued share options, this is the case which we were studying. First paragraph was irrelevant. This is the real case. However, where the subsidiary has previously issued share options, equity settled share-based payments to its staff, and by the acquisition date, these have not vested. See that special case, then the parent will have to buy out this equity interest as part of the purchase consideration. This can be done by the parent issuing new replacement options. The accounting challenge will then be to analyze the value of the new replacement options and split them between compensation for the pre-combination interest and any post-combination incentives. Right? So we need to split things between pre and post. And post. And don't worry, these I will solve the question with numbers. I will be solving question with numbers. Okay. Now, splitting the value between pre and post. Read this, please. What they are saying. The amount of the new replacement options that represent pre-combination services are capitalized as part of the cost of investment as they relate to a payment for an entity interest in the subsidiary, right? That is COI. The amount of replacement option that is pre-acquisition will be the proportion of the value of the original options that has been completed, right? For example, the total vesting period allotted by S company originally was 5 years. The total vesting period allotted by S company was 5 years, but right now at the date of acquisition only 3 years have been passed. Right now at the date of acquisition only 3 years have been passed. So that means the 3 upon 5 is the fraction. 3 upon 5 is the fraction for pre-period. 3 upon 5 is the fraction for pre-period. Okay. Now, while the amount attributable to post-combination services will be spread through the profit and loss as an expense over the vesting period because that relate to future employees. Okay. Post-combination period, the remaining 2 years is the post period. So for the remaining future 2 years, IFRS 2 will be applied, and you need to spread according to what you do in IFRS 2. Now let's do it with numbers. Wang has just Wang has just acquired all the equity shares. Wang has just acquired all the equity shares in the issue in Hiren. That means Wang is parent, H is subsidiary. Okay, for $100 million paid in cash. Cash consideration very simple. Investment debit, cash credit. No worries. As 100% of the shares were acquired, there will be no non-controlling interest. Obviously, 3 years ago, now this is the story. 3 years ago, Hiren had, now this is the past story of subsidiary company, past story of subsidiary company. You can see my sketch as well. You can see this sketch as well, please. 3 years ago, Hiren had granted equity settled share-based payment awards to its staff. Okay, these were due to vest after 5 years. Great. Just think, before 3 years this deal was offered, and this deal was for total 5 years, and now 3 years have been passed. So how much is the remaining time left? How much remaining time left? Obviously 2 years. 2 years is the remaining time left. Okay, accordingly, in addition to paying $100 million cash for the shares, Wang issued replacement equity awards to the employees of Hiren with a fair value of 51 million. See, wait, this is given by parent company. This is given by parent company, total $51 million. Now you need to split that how much of this 51 million related to pre, how much of this 51 million related to pre, and how much of this 51 million related to post. Don't worry, don't worry. This is the total amount of shares worth given by parent company that will vest in 2 years. Yes, 2 years must 2 years employees must stay after the date of acquisition. Okay, at the date of acquisition, the fair value of the original share award issued by Hiren was 25 million. Now wait, just throw out parent company from this deal. First of all, just throw out, remove parent company from this deal. Leave it. Think as company individually. Think as company and their employees individually. Think as company and their employees individually. Okay, so S company offered their employees a $25 million worth deal. S company, see this 25. S company offered their employees a $25 million worth deal. Okay, for 5 years. If they stay 5 years, they will get 25 million shares. Leave the parent company. Please don't think about parent, just as company. So just tell me, out of 5 years, 5 years and $25 million. If you stay 5 years, you will get $25 million. That was the deal. Okay, but after these 5 years, how many years have been passed? 3 years. That means employees have worked for 3 years. That means on the shoulders of S company, the responsibility is 3/5. On the shoulders of S company, the responsibility is 25 million into 3/5. 25. Take out your calculator, take out your pen and pencil. Come on, quick, do it. On the responsibility of S company, on the shoulders of S company, there is a responsibility of 25 million times 3/5. That's it. That is $15 million. This is the responsibility of S company to give shares at the date of acquisition for 15 million. So S company requested parent company to fulfill this deal. S company requested parent company to fulfill this deal, and the responsibility of S company was only 15 million. The responsibility of S company at the date of acquisition was only ONLY, only 15 million. But now this depends on the heart of parent company. Parent company is so rich, or parent company is so good, or parent company wants to impress people, or whatever. Parent company gave how much? Parent company gave how much? 51. So 51 minus 15, 51 minus 15, the 36 million amount is related to post. 36 million amount is the extra gift. 36 million amount is the extra gift related to post period. Come on, check it. See, I've used some different wordings. Total fair value of the original awards issued by S company is 25 million. Now, I was using the word responsibility. on the shoulders of S company. Now I've used a different word. Value in the mind of S company employees today. S company's employees were expecting this 25 into 3 upon 5. This is 15. This is 15. So this relates to pre-period. This relates to pre-period. This relates to pre-period. Okay. Now, just think P company issuing awards with fair value of 1 millions means out of 51, 15 million related to pre-combination services. So this will be part of COI. 15 million will be part of COI, and the remaining 36 million related to post services for the motivation of employees. Now, one more thing, as these 36 million relates to post period, these 36 million relates to post period, and the post period, the vesting period is 2 years. For post period, vesting period is how much? 2 years. So you need to divide, this 36 million by 2. You need to divide this 36 million by 2. So 18 million per annum you will be booking expense and equity, this is how we'll work. Wait, I will show you the the typed solution as well. I'll show you the typed solution as well. Did you understand this part? If yes, then please tell me. Okay, you people are great people. Now see this. Explain how Wang will account for the issue of replacement share-based payment. Already you have done, but let's do it formally. Calculate the goodwill arising on the acquisition of Hiren. Okay, now please read this. Giving you 2 minutes. Quick read. 2 minutes. Don't waste your time. 2 minutes. So as this 15 million will be part of COI, so the entry will be investment debit and other equity or OCE credit. Okay, right? And the remaining 36 million will definitely will be spread over 2 years. Remaining 36 million will be spreaded over 2 years. Okay. And now, my dear respected students, you can do that Leupold thing. Now, goodwill calculation, how to do goodwill calculation? It's very simple. As there is no NCI, so you don't need to think about full goodwill or proportionate method. As there is no NCI in this question, so no need to think about full goodwill or proportionate method. Simply COI less fair value of net asset. So there are two types of COI in this question. There are two types of COI. One is cash consideration. One is cash consideration of 100 million. One is cash consideration of 100 million, and the other is 15 million. Other is 15 million, that is replacement award. Remember the compulsory part. So 100 plus 15 115, 100 plus 15 115 is the COI, and the fair value of net assets given in the question was 70 million. So this makes the goodwill 45 million. This makes the goodwill 45 million. Okay, I hope you got it. This goodwill calculation was not important. Leave it. Thank you. Yes, one very good question, sir. Why we are crediting OCE? Because we have promised to issue shares. Very good. When you issue real shares, you credit share capital and share premium. Open your eyes. When you issue real shares, you issue share capital and share premium. But when you promise to issue shares, that is share option, then you credit other equity or OCE. I repeat, there is one word which is share option, and there is one word which is called real shares. If you have share options, you can't go to AGM and attend AGM and give votes. No. If you have real shares, you can go to AGM, you can attend the annual general meeting. Okay. So there is a difference between share option, share option and shares. Share options means you will get the right, you will get the shares in future. You will get the shares in future. Sometimes when I teach young students, so I tell the difference between share option and shares are engagement and marriage. Engagement and marriage. There are share option is like engagement, and real shares are like marriage. Okay, now I hope you guys got the point. I said whenever you issue real shares, you credit the share capital and share premium. But when you promise to issue shares, when you promise to issue shares, this this is like share option. And then you credit OCE or other equity. Okay. So in this question, we promise to issue shares. Replacement awards means we give share options. Okay. That's why OCE. Now listen, one more thing. This is related. Normally, this is the favorite area of examiner, the scope, the criticism. These areas are normally tested. They don't ask normal IS nowadays. They ask the technical issues. They ask the technical issues. Okay. Listen, look at me. Today you give shares to your employees. Wait, no. Today you gave a target to your employees to stay 1 year or 2 years. You gave a target to your employees to stay 1 year or 2 years, and then you will give shares. Means if employees stay 2 years, then you will give shares. So yes, this is IFRS 2 because you are taking services. You are taking services, and in return you are giving shares. So this is IFRS 2. But now let us say your employee stayed 2 years, your employee stayed 2 years. Okay, and after 2 years you gave them shares. Okay, so now your employee is not only employee but also shareholders because he got the shares. Now your employee got the shares, so not only he is the employee but also he is the shareholder. Okay, now after 2 years, listen the story. Now employee has shares. Now in future you issued a bonus issue. You issued a bonus issue or right issue. In future you issued a bonus issue or right issue. You issued a bonus issue or right issue. So obviously when we do bonus issue or right issue, so we issue shares to all our shareholders. So we issue shares to all our shareholders. So now our employee will also receive shares, but now he or she will receive shares in the capacity of shareholder. He or she will receive shares in the capacity of shareholder, not employee. So this second transaction is not in the scope of IFRS 2. Be careful. This second transaction is not in the scope of IFRS 2. Now, one more thing, listen. We issuing shares or cash equivalent to our shares. Listen. IFRS 2 is not always equity settled. It's maybe cash settled. Students, make your mind. It's IFRS 2 is not, it does not deal only with equity settled, but it also deals with cash settled as well. Okay. So now read the line. We issuing shares or cash equivalent to our shares means shares or cash equivalent to our share price in return of inventory at future date, but objective is physical delivery. Read this word. Objective is physical delivery, then this is pure IFRS 2. Look at here. For example, I promised, let us say you deal in tea or you deal in sugar. You have lot of stock of sugar and I want to buy sugar from you. So I made a deal with you. Listen very carefully. I made a deal with you that after 2 months I'll take 100 tons sugar from you at the rate $20 per share. I will take 100 tons sugar from you at the rate $20 per share, and I'll pay you in the form of shares. I'll pay you in the form of shares, or I'll pay you in the form of shares equivalent to my market price. Share I'll pay you in the form of shares equivalent to market price of my own 10,000 shares. Okay, so the first case is normal ordinary course of business, because I'm the businessman. I'm the businessman of sugar. Sugar is my inventory. So yes, if I settle this deal and I take the physical delivery and I sell my products in ordinary course of business, then this is normal thing. This is a very good thing. This is a very good thing. This is a normal thing, that your intention is physical delivery, your intention is proper business. So yes, this transaction is IFRS 2. You are buying goods, you are buying goods, you are buying goods. In return you are giving shares, or in return you are giving share price. You are giving share price of your own shares in the form of cash. So yes, this is proper IFRS 2. Excellent, clapping for you. But if we promise, but now this is a technical game. If we listen, today you have sugar, you deal in sugar. I told you to give me I told you that I'll buy 100 tons sugar from you at a fixed rate of $20, at a fixed rate of $20. Okay, and I'll pay you in the form of shares. I'll pay you in the form of shares, or I'll pay you the market price of my shares. Okay, but now my intention is not physical delivery. My intention is not physical delivery. Now my intention is gambling. My intention is gambling, because why did I make this agreement? I'm waiting for sugar price to increase. I'm waiting for sugar price to increase. For example, in the deal it is written $20. In the contract it is written that you will give me sugar for $20. Let us say the price moved up to $25. The price moved up to $25. So I'll transfer this contract to somebody else, and I'll get the top of $5 in the form of cash. That means now my objective is gambling. Now my objective is enjoying the price fluctuation. Now my objective is to enjoy the price fluctuation. This is not ordinary course of business. This is not ordinary course of business. So now it is derivative. It is derivative and simple. You have to apply IFRS 9. So these the second transaction which I told you, this is not in the scope of IFRS 2. This is not in the scope of IFRS 2. Okay, did you understand? Did you understand? I'm sure you have studied in your normal course this as well. I repeat once again last time, if your objective is physical delivery, ordinary course of business, routine business, that means I buy sugar and I sell. I buy sugar and I sell. And if I'm paying in the form of shares or market price of shares, my shares in the form of cash, then it's okay. This is proper IFRS 2. This is normal thing. But but if my objective is just to enjoy the price fluctuation, so this is a sort of gambling. And then this contract is derivative, derivative, in which the price changes with something else, with somebody else. So now if the sugar price goes up and down, the price of this contract will also go up and down. And my objective is net cash settlement. I'm going to settle this contract soon. I'm going to do net cash settlement. So here standard says this is pure derivative, and now you can't apply IFRS 2. Now this is in the scope of IFRS 9. This is in the scope of IFRS 9. Now this is basically a criticism. This is basically a criticism of IFRS 2. Back in around, if I'm not wrong, 2005 or 6, 2005 or 6, IFRS 2 came in 2005 or 2006. Okay, so when IFRS 2 came, the whole accounting world got disturbed. All accountants and directors got angry. They started crying. IFRS 2 made them cry. All majority big multinational, they cried. Why? Look at here. Before IFRS 2 launch, you know when these these companies used to give shares to their employees against the services. Against the services, they used to give shares to employees. They used to treat it like bonus issue. They used to treat this transaction like bonus issue. Have you ever studied bonus issue in life when you were babies? Yes. When you were F3 FA student, A levels student, high school student, you used to study bonus issue. And you know, bonus issue is always within equity. The entry of bonus issue is within equity, no expense, no expense. So just think the life, just think the life, just think the life without before IFRS 2. Give shares to employees and no need to book any expense, just enjoy. But when IFRS 2 came, IFRS 2 strictly said to make this entry on gunpoint. IFRS 2 said to make this entry on gunpoint. IFRS 2 said to make this entry gunpoint, make this entry on gunpoint. Okay, right? You getting? So now when IFRS 2 said to make this entry, so now this P&L debit, P&L debit. So big expenses started going in P&L. So the whole world stand up, whole accounting world stand up, and they raise these four questions. They raise these four questions that these are the problems with IFRS 2. These are the problem with IFRS 2, but standard board gives the reply. Standard board gives the reply. So please listen very carefully. These all are technical things. This will help you thinking more. To be very honest, once you start reading things, reading things, then your thinking is established. Then you have a critical thinking, and this thing will help you in clearing your paper and in the real life as well, in the real life. Because every time you don't go to see the IFRS book, sometimes you use your common sense. Okay, and IFRS in and IS IFRS is more about common sense. They are made by humans. They are made by humans, and these humans gave argument, real arguments. Okay, and today I will, in the end of the class, I'll guide you to do only reading. Now you don't have to do anything except reading. That's it. Now the first criticism is no cost, therefore no expense. No cost, therefore no charge. People said that we are giving shares, we are just giving shares, so why we should have booked the expense? There is no cost to us. We don't have to pay any cash, no cost. IFRS 2 said, no, these costs are valuable. These costs are valuable. You have a share price in the stock market. There is a worth of these shares in the stock market. So don't say no cost. Yes, there is a cost. There is an opportunity cost. If you issue if you issue these shares, if you issue these shares in the market, if you issue these shares in the market, you will get some big amount, and now you are sacrificing that amount. So there is a cost, there is a cost. Okay, so this was the reply. Number two, people said this expense does not meet the definition of framework. This is not according to the framework. So IFRS 2 said this expense is pure application of matching principle. IFRS 2 said this expense is the pure application of matching principle. Wait, when you give target to your employees, you say you give target to employees to do this, and then I'll give you shares. So by giving this target, employees start working hard. By giving these target, employees start working hard, and when employees start working hard, they make you earn. So that means you earn and your revenue will increase. When you earn, your revenue will increase. So when you are booking the revenue, when you are booking the revenue in the income statement, you should book the expense as well. So revenues and expenses will be matched. Revenue and expenses will be matched. Are you getting? So this is the pure application of matching principle. The third thing is EPS hits twice. See, EPS hits twice. Can you see the formula of EPS? EPS is basic formula of EPS is profit divided by shares. Basic formula for EPS is profit divided by shares. Profit divided by shares. Now wait. When you book, see this entry. When you book expense, When you book expense, your profit goes down. When you book expense, your profit goes down. And when your profit goes down, your numerator goes down, so EPS will go down first time. EPS will go down first time. Secondly, when you credit equity, that means ultimately you are issuing shares. So because of issuing shares, your denominator will go up. And when your denominator you will go up, your EPS will again go down. So there is a double hit. There is a double hit on EPS. So accountants were not happy. Now what IFRS replied, what International Accounting Standard Board replied? International Accounting Standard Board said, yes, EPS is hitting twice because these are two economic events. Number one, you are getting services, so you have to book expense. Number two, you are issuing shares, so it will affect your EPS. Very simple. I repeat again, or make it or more simple. Just think, take one example. Assuming you are not giving shares to employees. You called your employee in the room. And today you gave him salary first. And what entry you make with the salary? Expense debit and cash credit. Whenever you give salary to your employee, you make the entry expense debit expense credit cash, okay. And now employees was leaving your room with the cash. You said, wait, come back. And you ask cash, please give me cash, and then you issued shares. So now you'll make the entry cash debit and equity credit. So these are two transactions. Now see these two entries, cash and cash. See, if you cut these debits and credit, the remaining entry will be expense debit and equity credit. Okay, so these were two economic events. So this is very fair to have dual effect on EPS. Now the fourth and the last criticism, and this criticism was with numbers. I'll give you one example of GlaxoSmithKline, GSK. Listen, people said, you know one thing, this share option, if you have studied SBL paper or F1 paper, you know, when you give share option to your employees, there is one word which we call alignment of interest. Then alignment of interest is made. Because when you give share options to employees, you basically giving ownership to employees, so the interest of the organization is aligned, and they really work hard faithfully for the organization interest. Okay, because now they are owners. Now employees will become owner. So it's very good if some company is giving share option to employees. But now wait, when IFRS 2 is launched, many companies stopped giving share options to employees. And the best example is GlaxoSmithKline. It is written in the ICW main book, that 1300 pages book. There are two books of ICW corporate reporting. In that book, this example is written that in 2005, GlaxoSmithKline was giving this much $1 billion of share option. Next year, they reduced it to half, and they cut it down to on a very low level. So this is the evidence that because of that, after the introduction of this IFRS, companies stopped giving share options to their employees. So this is very bad. For the growth of companies and all. See, adverse economic consequences will come. People said adverse economic consequences will come. And you know what IFRS, International Accounting Standard Board, replied? International Accounting Standard Board said that if we didn't launch this IFRS, the consequences were more adverse. If we didn't launch this IFRS, the consequences were more adverse. Why? Have you heard the word comparability? Wait, just go before 2005. When this entry was not there. Just go before 2005 when this entry was not there. So just think, two companies at that time before 2005, there were two companies. One company was giving cash salary to employees, one company was giving cash salary to employees and they were booking expense, and one company was giving shares to employees, the salary in the form of shares, and they were not booking expense. So just think, these two companies are not comparable at all. These two companies are not comparable at all. Plus the company who is issuing shares not reporting faithfully, not following faithful representation. Just think. So before, without this is, there were more adverse consequences. So that's why board said this is excellent standard, this is excellent standard. Did you understand? Okay, now, you know, 7 8 years back, i was I love to do research on IFRS. It was my hobby to do, but now I am very busy, extra 10x busy now. So there was a time when I used to do a lot of research and I used to read the documents of PwC and Big Four documents. They are like PhD level documents. So once I was reading the guide of IFRS 2 and I picked this issue, and this issue is tested in last attempt December 2021 exam. This the issue which I studied in 2014 from that PwC guide. They tested this issue right in last December 2021, question number 4, the question which we will be doing today. Okay, now wait and see. I've written quiz. You guys have to reply in the chat box. Let me ask the question first. And those who have studied from me, or if they know this thing, I think I have taught this in normal class as well. If I have taught this in normal class, then no need to answer. Listen, look at me. Today, I promised my employees, I promised my employees, I told my employees to stay 3 years. I told my employees to stay 3 years with me, and then I'll give you, see this, then I'll give you 30% of my branch profit, or 30% of my company's profit. Look at here, in the form of cash. Repeat. Today I promised my employees, if they stay 3 years with me, then I will give them 30% profits of my branch of or my company in the form of cash. Cash. Tell me, is it equity settled, share based payment, or cash settled? Is it equity settled or cash settled? It is equity settled or cash settled. This is equity settled or cash settled. You people are innocent people. You are innocent. All from now, let's change the WhatsApp group name Innocent People. You all are innocent except few, except 3 4 people, all are innocent. Those who are saying cash settled, they are wrong, and those who are saying equity settled, they are also wrong. And those who are saying none, they are correct. They are correct. My dear student, wait, go slow, tuk. Listen, what is the name of IFRS 2? What is the name? Tell me the name. The name of IFRS 2 is share base payment. So now, whenever you promise your employees to give shares or cash related to your own shares, cash market price of your own shares, then this is IFRS 2. Otherwise, it's not IFRS 2. Read this question. There is, you are saying that we'll give you profits, we'll give you profits. So this is not share based payment, this is not share based payment. Yes, I made you confused. This is the technique, this is the interview question, this is how interviewer dodges. And this is how, when I take interview, I ask this question. I have many such questions with me. So my dear student, the answer is no, and this is in the scope of IS 19. This is in the scope of IAS 19, employee benefits. You are giving benefits to employee, you are given benefits, it's like bonus. So it's like bonus. This is in the scope of IS 19. Okay, now one more thing, one more thing. Also, listen. Let us say you all know this or no, or don't know, I don't know. The name of my institute is Mirchawala Institute. The name of my institute is Mirchawala Institute. Okay, so let us say it's a company. Today I gathered my employee. Today I gathered my employee and I told them if they achieve certain targets, then I'm the owner of Mirchawala Institute, and these are the employees of Mirchawala's employees, my institute employees. Today I gathered them and I gave them a target, and I asked them that if you do this, if you achieve this target, then I'll give you 5,000 shares of Apple company. You tell me this is equity settled or cash settled. You tell me this is equity settled or cash settled. You tell me this is equity settled. Now you guys are very, now you got the game. None. Again, this is not in the scope of IFRS 2. Again, excellent. Again, this is not in the scope of IFRS 2. Okay, and now read this scope. Please read it. You know, IFRS 2 is applied when you need to give your own shares, or your group shares, like parent, subsidiary 1, subsidiary 2, these all are group members. If you give your own shares or your group shares, okay, any group members can give shares, or you give the cash equivalent to the share price of your own or your group shares, then IFRS 2 is applied. If you say that we'll give you shares of Mercedes, or we'll give you shares of British Tobacco, or this and that, no, that's not in the scope of IFRS 2. So be very careful, people are very dodgy. Okay, so now let's move to the past paper. Get ready, question number 4. And I will tell you one thing, believe me, this whole question is related to an article which is given in the accaglobal.com. It is free, available on accaglobal.com. Almost 70%, 30% was the dodgy part which I just taught you. 70% of this question is total from article. Believe me, even after the class I'll send you that article. You will see exact wordings written in the articles. They have even told us all the treatment. Whatever is asked in this question, everything is written in that article. So, and you know, they are very smart people. You know, in the end of the article what they have written, that this is just the general knowledge article, don't expect that exact things will come in exam. It is written in the end of this article, and that article has come in the exam total. So just think the importance of the article. You people watch many lectures of financial instrument and this and that, but you don't read the examiner articles, those written by examination team, and that is the biggest help by ACCA UK for you guys. So I would recommend you to take out 3-4 days just for reading. You will clear. Many people clear because of those articles. I will show you the article now. So symbol company develops cryptocurrency funds and is a leading authority on crypto investing. Symbol company specializes initial coin offer, ICO. So listen, We guys have studied IPO. IPO. This is ICO, right? So now companies offers digital coins. Now companies offers digital coins, okay? And they take cash in return. They take cash in return. Now this topic is like crowdfunding, a slight touch of crowdfunding, a slight touch of crowdfunding. So for investors, those who invest, I'm telling you something about that article, okay? I'm telling you something which is not given in the question as well. So for the investors, if they initially subscribe this coin, this is a risky game, because if this coin got good publicity in the market, this will be a sixer. You earn a lot. And if this coin does not go good in the market, not accepted by the market, then your whole money is wasted. Sometime investors loses all money. And we all know this thing, that cryptocurrency is highly volatile product, is a high volatile product. Even in my development videos, I always say that only 3% or 4% of your total investment you should park. Only 3 to 4% of your total investment you should park, not more than that. Not more than that. Very risky items. So there was a word we used to study was IPO, and now the word is ICO, initial coin offering. Okay, now they sometimes offer coins for the cause. They generate money for a new app, new application, new software. Like it's a startup, like sometime it's like a startup. Okay, so they take money from the public, they take money from the public, in return they give the coin. And sometimes, not every time, and sometimes, look at here, not every time, these coins will be used in future to use that app. These coins will be used in future to use that app, to buy that app, or to buy that software. Sometimes, okay, right? But yes, there is a risk in that point, in that coin as well. Now the major issue, we are accountants, my dear students, we are accountants. You know what is the objective of IFRS? Look at here. We can't stop anybody to do any transaction. We can't stop anybody to do any transaction. Let them do. They want to do gambling transaction, advanced transaction, ending transaction, accrual transaction, prepayment transaction. Let them do. We can't stop anybody. But what IFRS do, when the transaction is done, we guys do recording. We guys do recording, and we report that transaction to the external world. We report that transaction to the external world. Okay, that's our job. We are accountants. Okay, so now we have to decide that the money which we have received, the money which we have received from the public, the money which we have received from the public is equity, is a loan, is equity or a loan, or it's an income. What is the classification? What is the classification? That's the real game. That's the real game. That's we have to decide. So we'll study this. We'll study this, and this is all discussed in that article as well. Wait. Now, so development costs, see, this is the diagram, this is the diagram. This is symbol company. We are symbol company, issues token, we issues token, and investors gives us cash or cryptocurrency. Just assume investor is giving us cash. In simple terms, investor is giving us cash. Now we will make a platform. See, this is the platform. We have made this platform. This is a funds used to develop trading platform. Just think, investors gave us cash, we gave them token, and from that cash we developed this fund. From that cash, don't sleep please, I am also not sleeping. From that cash we developed this fund, this software, this electronic software. We made this electronic software, and now in this software people will buy and sell. From the market, people will also come, external people will also come, and these people will dump these coins, and their trading will start. Trading will start, and the price will go up or down. Price will go up or down. Now initially we receive the cash. Initially we receive the cash, and in future, when these investors uses this funds, when these investors uses this platform, the best word is platform, the best word is trading platform. In future, when investors will be using this platform, they will give us some profit. See, percentage of fee from trade tokens. So these C means future economic benefit, means we will get future economic benefit from this platform. We will get future economic benefit from this platform. Are you getting? So now one more question, one baby question, and this is also discussed in that. This is also discussed in that. And that question is the making cost of this platform, the the initial cost of this platform should be capitalized or not. The initial making cost of this platform should be capitalized according to IS 38 or not. So the basic criteria is, you know what is asset? Asset is anything which is in our control and which gives us future economic benefit, which is in our control and which gives us future economic benefit. Now open your eyes, read this. What is this? What is this? What is this? Yes, we will be getting future economic benefit. Yes, we will be getting future economic benefit. Today we are investing, and in return future we'll get economic benefit. So that's why the making of this software, the making of this trading platform cost should be capitalized, should be capitalized. Now the term token or and coin means the same, and investors are often yes, supporters. See, investors are often referred to as supporters. Remember I told the word crowdfunding. Remember I used a word crowdfunding. So in crowdfunding, the people are supporters, the people are supporters for a new startups. Okay, now an ICO. Now be confident, I have told you the major heart of this story. Now your flight will go smooth. An ICO issues tokens to investors for cryptocurrency or cash. Receive the cash. For each ICO, symbol company establishes a separate payment platform. See, the payment platform, the trading platform on which the investor can trade the tokens. Okay, these tokens do not represent an ownership interest in the entity. So listen, there are two words. One is IPO. IPO, initial public offering. Hope you know the shares. When a limited company issues shares, so shares are equity instrument. Shares are equity instrument because shares gives ownership interest to investors. Shares gives ownership interest to investor, but these tokens do not give any ownership interest to the investors. So that's why this is not equity at all. This is very clear, this should be very clear, it's not equity. And you know one thing, it is written in that article as well. It is written in that article of accaglobal.com as well. That's why nowadays it is a fashion. That's why nowadays it is a fashion to issue. It is a fashion to issue coins ICO instead of IPO, because in IPO when you give equity rights, ownership interest, so there is a detailed investigation by SECP. There is a detailed investigation or legal laws of SECP, but here right now the laws are relaxed. So that's why people are going towards this. One more thing related to ethics. Listen, one more thing related to ethics in that article, that when ICO is done, initial coin offering is done, listen to me, when ICO is done, there is a white paper issued by the company. There is a white paper issued by the company in which company promises that we'll do this, we have this plans, we'll make this platform, we'll do this. So in that white paper, many people don't write the truth. Many people don't write the reality. So this is the bad part of accounting profession. This is the bad part for accountants, and this is unethical. This is unethical that you are doing wrong promises, you are doing fake promises. This is also written in that article, but you guys don't have time to read articles because you are totally dependent on your teachers, and that's good for your teachers. Stay dependent on us and don't do anything. Now, next thing. Now, at 31st, sorry, symbol company promises to produce gain for investors from trading tokens on the platform, and in return the company takes a percentage of profit from a fee. Yes, this is the economic benefit. This is the economic benefit the company will get. Okay, and if this economic benefit is material amount, then you can easily capitalize, that initial platform making cost. Okay, now one more thing. At 31st March X7, symbol company has incurred significant cost in promoting the issue, incurred significant cost in promoting the issue of the ICO tokens. This is promotion cost. Now please handbrake, pull the handbrake. This is promotion cost, means advertisement cost. Promotion cost is a different thing. Look at me. Promotion or advertising cost is a different thing, and making a trading platform and making a software is a different thing. Keep these two things separate. I said yes, you can capitalize. Yes, you can capitalize. You can capitalize your trading platform cost because you are getting economic benefit. But I don't have this much confidence to say this, that you can capitalize advertising cost, promotional cost. No, since years it's IAS, not IFRS. IAS 38. IAS means launch before 2001. The standard launched before 2001. IS 838 says you cannot capitalize advertising costs. Simply go in PNL. Simply goes in PNL. Why? Let me tell you. Because if you do advertisement, the future economic benefit is not in your control. Plus the economic benefit which you get from the advertising, it's not separable, it's not identifiable, it's not separable and identifiable. And IS 38, this identifiability condition is written in the criteria. One more thing, because of this advertising, when you do advertise, your internally generated goodwill goes up. And we all know that we cannot capitalize internally generated goodwill. That's why don't think of capitalizing this promoting or advertising expense. This is very simple. This is a basic issue decided years before. This is a basic concept which has been decided and done years before. Okay, now, so one cost is promoting the issue, this is PNL. And yes, the second cost, this is a very good cost, developing the trading platform. Yes, for dealing with the purchase and sale, for dealing with purchase and sale of ICO tokens. Okay, these costs have been met from its own capital and expense. Oh, they are very superman people. They book immediately all these cost and expense, and this we have to discuss in one of the requirement. Do you think the complete amount should go in expense? The answer is no. I just discussed, the answer is no. Only the promoting expense will go in PNL as an expense. The remaining trading platform cost may be capitalized if you are expecting a good profit, if you are expecting economic benefit, and if it is in your control, then you can capitalize it. Okay, this is the simple thing and not difficult. Symbol company will earn revenue from supporting the purchase and sale of tokens. Yes, we'll get the percentage, we'll get the percentage. Now, next part, let's do one thing. I have read the half of the question. Now let me go to the first requirement. I can teach you first requirement very well. I can teach you first. It's a general requirement. It's a general requirement, and yes, you and these requirements only those people can do, those who are good readers. Those who are good readers, those who are good readers, those who are good readers. Sorry, the question is a little bit, there is an issue in the requirement, but okay, no issue. I'll read the remaining. I will try to read the remaining part. Okay, yes. What is the first requirement? Okay, the first requirement is not here. Can you write the first requirement? Can you write the first requirement, students? Can you write, or let me read the first requirement? It's a during pasting some mistakes have been done. No, don't worry, don't worry. The first requirement is the first. Let me read the first. I'm reading the first requirement. Okay, please don't be kids now. You guys are mature. Explain the principles of good disclosure. Listen my question. Explain the principles of good disclosures which should be used to inform investors regarding the company's holding of crypto assets. I repeat, slow, slow, slow. If you want to write the question, you can write it. It takes 1 minute, less than 1 minute. Explain, write it down. Explain, I don't have pen, otherwise I would have written it. Explain the principle, explain the principle of good disclosure. Explain the principles of good disclosure which should be used to inform investors, regarding the company's holding of crypto assets, Now this is the question. This has nothing to do with this has nothing to do with this overall question. You can do general discussion on this as well. You can do general discussion on this as well. Did you understand the question? Now, first thing, let me just give you some words. First of all, crypto, since see you are giving a practical paper and you examiner knows you are the students of 2022, not 2002. You are 2022. Okay, so there is a boom in crypto world in last 3-4 years, extreme transactions in cryptocurrencies. Okay, so that's why, see, investors wants to know if you are holding any crypto assets. Investors wants to know because they are material assets. Now you can see the price of Bitcoin, it moves from $10,000 to $60,000, and there are many variation in crypto world. Okay, so investors wants to know what are the ups and downs in it, what are the ups and down in it. Okay, but one thing, there is an article on accaglobal.com, and even I recorded a class for that article as well. The name of that article is bin the clutter. There is an article on accaglobal.com, and name of that article is bin the clutter. In that article, they openly criticize the companies for heavy disclosures. Believe me, nowadays people don't have time to read the disclosures. Even you guys don't have time to read the articles. You guys don't, you have a paper and you have no time to read the articles. Just think, so a routine investor can't read all the disclosure, all heavy duty disclosure, they can't read. So now people are emphasizing to reduce the requirement of disclosure. So that's why for a good disclosure, you should be entity specific. You don't need to put all general things which are the common knowledge of the all public. Those things which are the common knowledge of the public, no need to write it again. try to write specific things related to your cryptocurrencies, your coins, your ICO, the characteristic of your ICO, like this. Okay, so this is how you will build up the answer. Now one more thing, you will be writing the risk and reward. See, we are accountant, we are IFRS people. I just told you, let the world do the transactions what they want to do, but once they do the transaction, then we explain to the external world, is this debt or this equity or this is income, what is this? So we should make the disclosure in such a way that we should highlight the important points. We should highlight the important points. We should highlight the risk and reward. We should highlight the risk and reward of these tokens to investors, so that investors do not take a wrong decision. This is how we should plan. Then one more thing, don't worry, I'll give you the answer as well in the written form. Don't worry, first let me make your mind. Let me make your mind, because you guys need first mind making and then you go to the solution. Then you need to show the connection. Look at me. Then you need to show the connection of cryptocurrency with the rest of your financial statement. Connection of cryptocurrency with the rest of your financial statement. For example, look at me. For example, you have mortgaged your cryptocurrency and you have taken loan from the bank. For example, a bank accepts the cryptocurrency and you have taken charges on cryptocurrency. So now this is related to your loan. This will be linked to your loan. One more thing, crypto, I told you that cryptocurrency has got linked with the other parts of the financial statement. So if you are keeping, if you are recording it as an inventory, if you are recording it as inventory, there is a possibility for traders. If you have read the articles, listen to me, if you have read the article of cryptocurrency available on accglobal.com, so they have openly told us that for token traders, those who do in ordinary course of business full day and night, and those who want to enjoy the fluctuation, the price fluctuation, they buy it like inventory. So they record, they use is2, and they record their inventory. They record their inventory at fair value less cost to sell. They record their inventory at fair value less cost to sell, so that means there will be price fluctuation which will hit the PNL. So now you have to connect it with PNL. One more thing, for a normal common man, please don't sleep. For a normal, look at here, for a normal common man, those who buy cryptocurrency, they record it as is38. Let me teach you something. It's right time to teach. Listen, sir, why the cryptocurrency is not cash? Why cryptocurrency is not cash? Because through cash you can buy anything. Cash is exchangeable for goods and services, but till now the whole world did not accept, the cryptocurrency, so it's not cash. Okay, the second argument, is this cash equivalent according to IAS 7? Is this cryptocurrency's cash equivalent according to IAS 7? Big no. 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 Why? Why? Have you ever studied the definition of cash equivalent? Have you ever studied the definition of cash equivalent? Cash equivalents are those liquid investments. Open your eyes and ears. Cash equivalents are those liquid investments which are readily convertible into cash, and they carry insignificant risk. That means no big risk. Involved in cash equivalent. And cryptocurrency is full of risk. Cryptocurrency is full of risk, top to bottom, top to bottom. It's a drink full of risk. So it's not cash equivalent. It's not cash equivalent. Now, sir, cryptocurrency is a financial asset. It's a financial asset. Can we record it at fair value through P&L? No. No. I'm telling you the whole article. Okay. This whole article is in my mind. I'm giving you the whole article because you don't have time. Sorry. So cryptocurrency, can we record cryptocurrency as financial asset? No. No. Why? Because the financial assets are cash, cryptocurrency is not cash. Right to receive cash? No. You know the tokens, ICO tokens. Did you study ICO tokens? These token people say we are not doing any commitment to give you money back. No, no, no. There is no contractual right, and they are not even equity instrument. We just read together. We just read together this question, that no equity interest, no ownership interest in it, no ownership interest in it, no ownership interest in it. Okay, so that means they are not financial assets. So last category is IS 38. Yes, they are non-monetary. They are non-monetary. Cryptocurrencies are non-monetary because non-monetary means it is not cash, and there is no right to receive cash because it fluctuates so speedily, so it's a non-monetary asset. And it's intangible asset. It has no physical substance. It has no physical substance. So that's why for a common man, for a common investor, IS 38 is applied. For a common investor, IAS 38 is applied on cryptocurrency. Now look at me. Do you know, have you ever studied IS 16? Have you ever studied IS 16? Yes, 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 please, please. So in IS 16, there are two measurement models. There are two measurement models. Don't sleep. Cost model and revaluation model. Same is the case with IS 38. Same is the case with IS 38. IS 38 has also two measurement models, which is cost model and revaluation model. Cost model and revaluation model. But one thing which you all guys must know, that in IS 38 revaluation model is only applied. In IS 38, revaluation model is only applied when active when active 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 market of that intangible asset exists. Active market means daily basis few transactions, are done. So normally it is written in the IFRS book, and many trainers say this in their lectures, that 99% of the intangible asset does not have active market. 99% of intangible asset does not have their active market, except few. But yes, cryptocurrency has active market. Cryptocurrency is the ideal example. It has active market. It is normally traded on a daily basis. It is normally traded on a daily basis. One more example I can give you, and I used to give this example since last 6 7 years. In New York, the taxi government has allowed you to sell the taxi license. Your taxi license is transferable in New York. So if you have, and in New York there is a lot of population because it's a hub. It's a world's financial hub, like London and like New York. New York is, I think, better than London. So in New York they need lot of taxis, so government has allowed to transfer. You can sell your taxi license. So normally in past, but right now it's not. Now after Uber and these all new software application companies, I don't know what is the current scenario, but in past tax government allowed to sell your taxi license. So yes, that taxi license is sold on a daily basis. So that taxi license also has an active market, so you can apply revaluation model. But yes, come to the point, you can apply revaluation model on Bitcoin. You can apply revaluation model on Bitcoin. Okay, so we were discussing disclosure, but you took me to cryptocurrencies. Sorry, let me come back. But these discussion were beneficial for you, these, because you need to keep things and you need to fill your mind with these short things, and you will reproduce this thing on the exam day. You will reproduce this thing on the exam day. Okay, so now in this disclosure, you need to write IS2 disclosure as well. IS2 disclosure as well if you are a trader and if you are trading the cryptocurrencies in ordinary course of business. So you need to write you need to disclose fair value less cost to sell, fair value less cost to sell of your crypto assets. Okay, but yes, if you are IS38 guy, if you are IAS38 guy, a normal investors, then I'm sure you guys know, but it's non-routine thing. You have to show a reconciliation. Even in IAS 16, even in IAS 16 disclosure, that this is written that you have to show a reconciliation from opening carrying amount of total assets to closing opening carrying amount, opening NBV to closing NBV. So same is the requirement with IS 38. You need to show a reconciliation of opening intangible assets to closing as intangible assets. You need to report all the movements upward or downwards of that intangible asset. One more thing which you have to write about intangible asset, and that is the life, that whether the life is finite life or indefinite life. If the life is finite life, then you have to amortize, you know this. And if you conclude that the life is indefinite life, if you conclude that the life is indefinite life, then you have to prove on what basis you decided that this life is indefinite. On what basis you decided that this life is indefinite? You have to give that disclosure as well. Okay, finally, the disclosure of materiality. The disclosure of materiality, there is a probability, my dear students, that last year you had 5 bitcoins, and one bitcoin was $10,000. One bitcoin was $10,000. That means the total number of bitcoins, you had 5 bitcoins, 5 multiplied by 10,000 is 50,000. And your company is super rich, so $50,000 is nothing for you. Your company is $1 billion company, so $50,000 is nothing to you. But let us say now the price of bitcoin, one bitcoin is $1 million, and it is possible 1 bitcoin is equal to $1 million. So now 5 bitcoin means $5 million. So now the materiality has changed. So you should give this thing to shareholders as well, that the materiality has been changed. One more thing you can write, IFRS 13. Yes, open your eyes. I used the word fair value 2 times in my lecture today. One for IS2, fair value less cost to sell. For IS2, if you are a trader, then you will be doing at fair value less cost to sell. And if you are using IS38, if you are recording your crypto assets using IS38, using IAS38, still if you are using revaluation model, then you need to revalue, you need to bring your crypto assets to fair value, so for fair value, IFRS 13 is must. And if you have ever read the book of IFRS 13, or if you have ever attended the lectures of IFRS 13, you know you have to give lectures, you have to give disclosure of recurring and non-recurring transactions. There are some transactions, there are some transactions for which you have to give, they are recurring transactions of fair value. There are some transactions which are recurring, and there are some transaction fair value which are non-recurring. Let's start the quiz. Come on, come on, boys and girls, boys and girls. Can you give me the example of recurring fair value transaction? The fair value transaction on which we have to compute recurring fair value. Yes, yes, I'll give you the break, but first, because I badly need the break. Today I took two sessions of 3 hours. In the daytime I took F6 TX session, the taxation class of 3 hours, and now 3 hours again. Yes, excellent. Shares are recurring because you keep shares for long term. So every year the same shares. Investment property. Investment property is one more transaction. Investment property is one more transaction. Investment property is one more transaction. You keep it for years. So it comes in every years. It comes in every years. It comes every year. Okay. So this is the example of recurring. Now you tell me what is non-recurring. There are some transactions for which we need to compute fair value once in life. Once in life. There are some transactions for which we have to compute fair value once in life. Excellent. IFRS 5. IFRS 5, at the time of classification, you just have to bring it to fair value even if you are using cost model. And the second example, fair value of acquisition of subsidiary. Yes, when parent company acquires subsidiary company, then at the time of takeover you have to bring complete subsidiary company to fair value. So that is also a non-recurring one-time fair value transaction. So my dear students, ifrs 13 says to make separate disclosure for recurring and separate for non-recurring. Okay, now just read this requirement, let's read it out so that this lecture becomes fruitful. See this, it's easy. I have explained you in extreme depth. This is nothing, this solution is nothing in front of my lecture which I just gave you. Come on, read it yourself. I don't have energy now. Read it. Okay, see this, the third, crypto has increasingly grown, we know that. So your shareholders your investors are interested. Principle number one, make it entity specific. Okay, don't make it all general information because normally people know the general information. Okay, now write about your crypto and ICO. I just told you. Principle number two, the information should be organized in such a way that, yes, I told you, highlight important matters, underline, highlight, bold. Okay, the term ICO should be disclosed in order to help the investor determine their rights. Yes, use the word not only the rights but also the risk and reward. Even I discuss you the equity and debt at this place. Then link with annual report. The information should be linked with the annual report. That what is the link? What is the link of crypto assets with annual report? I gave you the example of mortgage. I gave you the example of P&L fluctuation, right? Then if you are a commodity broker, then you have to treat it as inventory and then you have to record it at fair value less cost to sell. Fair value less cost to sell. Okay. Finally, if you are a normal investor, then crypto assets are IS 38 for you, intangible assets. And then in intangible assets, you have to report the reconciliation, right? You have to report, this is the requirement of intangible standard as well as IS 16. In IS 16 as well as IS 38, that you have to write reconciliation between opening and closing carrying amounts, and also the indefinite life or finite life. Okay, and if this is indefinite life, you have to give reasons. You have to give reasons why the life is indefinite, why you assume the life as indefinite life. Okay, did you understand? Please be honest, be honest, be honest. Did you understand this all? Write down in the chat box, please. Yes, yes, 80% is good. Say thank God to, say thanks to God. If 80%, yes, now you are getting break because I need break. Okay, let's start a 20 minutes break. Enjoy, enjoy. Okay, welcome back. Welcome back. Now, the next requirement, let me we have already discussed the second requirement, but we have to see. And I have the requirement with you. See, this is the requirement. See, this is the requirement. Advice whether the various development promotional costs related to the ICO can be accounted for as an intangible asset. Advise whether the various development and promotional. Okay, so simply you have to start this with the concept. First of all, you need to write the criteria that if you have probable chances of economic benefit and if the cost is reliably measured, then you can easily book the asset. But if there is no probability, if there is no confirmation of probable chances of economic benefit, then you cannot capitalize the asset. Okay, so in this question, when I showed you the chart that ICO will getting future economic benefit from this trading platform, ICO will be getting ICO will be getting future economic benefit from this platform by taking the percentage from the profit. Okay, so this is basically their economic benefit. So on the basis of this, they can capitalize this trading platform. But to be very honest, they can't capitalize the they can't capitalize the promoting expenses at all, the promotional expenses like advertisement cost at all, right? It, according to IS 38, it goes in the PNL, and I gave you the logic as well. Because this all advertising creates your internally generated goodwill, and we can never capitalize internally generated goodwill. Okay, let's see. Let's see now. This is 4b. Okay, the first is IS 38. If the costs do not satisfy the requirement of IS 38, they are recognized as expenses, hence expenses the cost as incurred in the PNL. If the cost does not meet the development criteria of IS 38, simply book it in PNL. Now, but as per IS 38, the cost satisfies the requirements of recognition intangible asset if and only if it is probable, I told you, probable that the future economic benefit which are attributable to the asset will flow to the entity, and the cost of the asset can be measured reliably. Okay, plus one more thing. Asset is anything for which the future economic benefit is in your control. The probability of future economic benefit must be based on reasonable and supportable assumptions about conditions which will exist over the life of asset. Okay, that means the assumptions should be reasonable. The assumptions should be reasonable. Okay, now, decision making. Symbol company should evaluate about whether after the issue of the tokens it is still capable of controlling the trading platform, and whether it may reasonably expect the future economic benefit from the token holders. If yes, it is important to know whether the symbol company will be able to get future economic benefit from token holders by providing them with future services other than issue of tokens. Means, wait, in the beginning we are giving them tokens and we are taking money, and now from after this trading platform will work. After this they will buy and sell these tokens in the trading platform. That's a separate activity, and then trading platform will make us earn. And we'll get the share, we'll get the profit share from trading platform. So it's a separate economic benefit. So there is a separate economic benefit from trading platform. That's why the development cost of trading platform may be capitalized. If cost incurred will not ensure future further economic benefits, they should be immediately recognized as an expense in profit and loss. Yes, in this case, symbol company promises to produce gains for investors from trading the tokens on the platform, and in return the company takes, see, this is the economic benefit openly you are writing, in return the company takes a percentage of the profits as a fee. The cost may be recognized as an intangible asset and amortized over the useful life of these assets if the life are finite. If the life are finite. However, see, this is the clear cut thing. However, IS 38 states that an entity should expense promotional activity cost. All promotional activity costs like advertising cost to P&L, all promotional activity costs like advertising cost to P&L, like advertising cost to P&L. Okay, now these were the two parts. Now remaining two parts are left. One is related to debt and equity treatment, and the last one is related to IFRS 2, the dodge which I just gave, the quiz which I asked you at the end of IFRS 2 discussion. Remember, it is related to that, so you can easily understand. Don't worry, be confident, you will understand everything. Did you understand this part also? Please comment. Okay, now this is about ICO arrangements. Now wait. First of all, keep one thing in your mind. There are two accounting period. The first one is 31st March X7. The first one is the accounting period 31st March X7, and the 31st second one is 31st March X8. The first one is 31st March X7, and the second one is 31st March X8. Give me 1 second. One second, wait. Okay. Now, so there are two accounting periods. One is 31st March X7 and the second one is 31st March X8. Okay. Occasionally, symbol company enters into a pre-sale agreements to raise funding from selected investors prior to public sale of tokens. This happens in my country as well. In construction industry, I've seen this pre-sale, pre-launch. They call it pre-launch. Before launching the project officially, these constructors sells the different projects to their friends and family, and they arrange funds, and they give initially some discount. So same is the case here, that before official funding date, they take they arrange some finance before that date. See, and this is called pre-sale agreements to ensure some funds. Okay, now symbol company has entered into a pre-sale agreement with an investor, which entities the investor to 10 which entitles sorry this is typing mistake which entitles the investor to get a 10% discount on the price for tokens compared to other investors at the time of ICO. You got it? Now those investors who will invest in pre-sale, they will get 10% discount on the final day. they will get 10% discount on the final day. Okay, now on 1st March X7, on 1st March X7, the investors paid symbol company 1 million in cash. 1 million in cash. 1st March X7, underline this date. Underline. See, underline. 1st March X7, that means before 31st March X7. Our first accounting period ends on 31st March X7, and we receive this $1 million, and we received this $1 million, and we received this $1 million on 1st March X7. That means before the year end. Before the year end. Okay, the year end is 31st March X7. Now the issue date of the ICO is 30th April X7. That means after 1 month of the accounting period end. The issue date is after 1 month of the accounting period end date. The cash is only refundable if the ICO is abandoned before 30th April X7, because the minimum funding level of 9 million has not been achieved. This is the problem. Listen, we have openly told these pre-sale guys, the pre-sale agreement guys, those who gave us advance, that yes, we'll refund you the amount. We will refund you the amount if we didn't generate the complete funds. And this funding is not in the control of the company. This funding is not in the control of company. So yes, this is a financial liability. Right now it's a financial liability. Right now it's a financial liability. So because it's not in our control, we have a contractual obligation to deliver cash. We have contractual obligation to deliver cash based on certain conditions. If certain conditions are not met, then we have to pay. So yes, it's a financial liability now. It's a financial liability now. You have studied this in financial instrument, that if you have a contractual obligation to deliver cash which is based on certain events, then this transaction is a financial liability. So the first treatment, look at here. Before 31st March X7, we'll make this entry: bank debit and liability credit. 31st March X7, at 31st March X7, we'll be making this entry: bank debit and financial liability credit. Bank debit and financial liability credit. Bank debit and financial liability credit. Okay, now next step, this 31st March X7 gone. Next para: once the tokens are issued, see, let us say we are on 30th April X7, we are on 30th. Once the tokens are issued, ICO investors can readily convert them into cash or cryptocurrencies on symbol companies platform. But they do not, these are crystal words, do not entitle the holder to the future goods and services from symbol company. Means symbol company does not have any obligation to give anything in future. This is, I'm talking about 30th April X7. Please show some energy. On 30th April X7, when the tokens are issued, and the company received cash, when the tokens are issued to investors and the company received cash, from that date, after this date, there is no obligation on this company. What was the name of the symbol? Yes, symbol company has no obligation. See the word. But they do not entitle the holder to future goods or services from symbol company. There is no obligation on symbol company. Okay, so that means the amount which we are receiving, on the token sale. I'm not talking about pre-sale now. It's a normal day, 30th April, this day. I'm talking about this day, please. On this day, there is no obligation now, other than supporting the purchase and sale of tokens. Simply we'll provide the platform, we will provide the platform, trading platform, where they will do sale and purchase, but we are not responsible for anything. Okay, now the inflow received for tokens are used, the inflow received for tokens are used by symbol company to fund future development of the payment platform and other projects. Wait, you know, whatever money symbol company will receive from tokens, symbol company will use it to fund future development of the payment of platform and other projects. But listen, symbol company has no obligation to do it, that's their own wish. This expenditure, it's their own wish, so there is nothing, there is no obligation at all, there is no obligation at all. Now, in order to, so my dear student, make it very clear, make it very clear that this transaction is not a liability, this transaction is not a liability. Okay, in order to induce investment in the ICO, symbol company has made a commitment to the holders of the tokens to pay a single payment of 10% of any annual profits for the year ended 31st March X8. This is the one-off payment, this is the one-off payment we'll make to all the investors. If there is a, see, 10% of annual profit, 10% of annual profits, 10% of annual profits for the year ended 31st March X8, 10% of annual profits for the year ended 31st March X8. That means this is also a contingent payment. If there will be a profit, then we'll pay. If there will be a profit, then we'll pay, otherwise we won't pay. If there will be a profit, then we'll pay, otherwise no need to pay. The holders do not have any other rights such as redemption of their tokens or see, or any residual interest in the symbol, in the assets of symbol. This is the crystal clear thing. The holders do not have any other rights such as redemption, these are not redeemable, so there is no contractual obligation to deliver cash. There is no contractual obligation to deliver cash on the company. Plus, there is no residual interest in the assets. You know, wait, have you ever studied the definition of C is equal to A minus L? If you ever read financial instrument IS from any book or any article, there is a definition of equity is written. The definition of equity is the residual interest in assets after deducting all liabilities. Residual interest in assets after deducting all liabilities, this is called equity. So my dear, the token holders have no rights in equity as well. See, there is no rights in residual interest in the assets of symbol company. So this is not equity and this is not debt. You forgot. When I before the break, please, before the break, when I was telling you the article thing, that article, remember, I was giving you a reference of article. What is the difference between IPO and ICO? In IPO, when you issue shares, you give residual interest of the asset, you gave equity rights, you gave ownership interest. Yes, the good word, you give ownership interest. So when you give ownership interest, so there is detailed investigation by SECP and all. But in ICO, there is no ownership interest and there is no redemption gain. So now it's like revenue, the 10 million. See, the ICO raised $10 million on 30th April X7. The ICO raised $10 million on 30th April X7. Now in these four lectures, this today is the fourth lecture. In these fourth lecture, once I taught you this technique, listen. Whenever you receive money, see, you debit the bank, you receive $10 million. Now you can credit one of the three things. You can credit one of the three things. One is liability. First, you can credit liability. Do you have any contractual obligation to deliver cash? Ask yourself, do you have any contractual obligation to deliver cash? Do you have any contractual obligation to deliver cash? No, these are not redeemable instruments. Number two, did you give any ownership rights of your company to these tokens? No. Did you give any residual interest in the assets after deducting all liabilities? No. So this is not equity, this is not liability. So what is the left? Income. This is income. We just earned it. We just earned it. No more obligations. No more obligations. We just earned it. If you remember, yesterday I taught you, in the last meeting I taught you crowdfunding. In the last meeting, or yes, day before yesterday, I taught you crowdfunding. So I taught you 3 classes in crowdfunding. Remember, sometime crowdfunding is treated as equity, sometime crowdfunding is treated as debt, sometime crowdfunding is treated as income. This is the case. See, this is income. We have no obligation now. We have transferred everything. We have transferred everything. We have transferred everything. Okay. Now one more thing. This entry will make, in the year ended, this, see, in the year ended 31st March X8. This entry will make in the year ended 31st March X8. It's my humble request. Please write the accounting period through pen. Please write the accounting period through pen. Listen. The first accounting period ends on 31st March X7. The first accounting period ends on 31st March X7, and the second accounting period ends on 31st March X8. Okay, so please be careful, otherwise all this hard work will be wasted. Listen, this entry I made in the last year, and this entry related to pre-sale. You remember pre-sale, guys? Pre-sale guys gave us money, and to those guys we just promised them to refund. We just promised them to refund if we won't be able to launch this token. Okay, so yes, at that time we had contractual obligation to deliver cash. At that time we had contractual obligation to deliver cash. Okay, but once, listen, but once on 30th April X7, that means in the next accounting period, but once on 30th April X7, that is on the next accounting period, you really issued the, you did the short, you played the short, and you arranged $10 million. So now on that day, first of all, you make bank debit and PNL credit 10 million, plus that liability will also be reversed. That liability of 1 million will also be reversed in PNL, because now you have no obligation. You have successfully launched the token, so you will be given you will give token to those pre-sale guys as well. You will give token to those pre-sale guys as well, and those pre-sale guys are now normal token holders. Those pre-sale guys are now normal token holders, nothing else. Okay, so this is how you will formulate, this is how you will formulate. Now only one thing is left. Only one thing is left. Sir, what about that 10% incentive? Only one thing is left. Just giving you 30 seconds or 1 minute to think over it, then I'll speak up. 1 minute or 30 seconds to settle down. See, you may ask, sir, what about this thing? This thing, in order to induce, investment, see, this symbol has made a commitment to the holders of the tokens to pay a single one time, not every year, one time single payment of 10% of annual profit for the year ended 31st March X8. That means if we get profit this year, then we have to pay, otherwise no. If we get profit, then we have to pay. So it's like a contingent liability. Have you ever heard about possible obligation? Have you ever heard the name of possible obligation in basic accounting? Possible obligation is an obligation who is dependent, in which outflow is dependent on uncertain one or more future events. outflow is dependent on one or more uncertain future events not wholly controllable for that organization. So for possible obligation, normally we make disclosure of contingent liability. Possible obligation, normally we make disclosure of contingent liability. But sorry, don't mind. Once it is confirmed that we have profits, once it is confirmed that we are in profit this year, then we have to book a liability. Then we have to make the entry expense debit and liability credit. Then we have to make an entry for this, which is expense debit and liability credit. Now let's read it. Let's go. Let's walk through it. You will understand. You will understand more now. See this. The first thing, the success of the ICO is not within the control of symbol, as the ICO can be abandoned if the minimum fundraising level of 9 million is not reached. Remember, this is about initial sale. This is about initial sale. This is about initial sale. Okay, you remember we received some money from initial sale, guys. We received some money from initial sale, guys, right? So that 1 million, 1 million is a liability. Now neither does the investor have the right to be repaid 1 million in cash prior to 30th April X7. However, on the basis of the occurrence of a successful ICO is beyond the control of the entity, the agreement contains a financial obligation because it represents a contractual obligation to deliver cash or another financial asset to another entity if the ICO does not occur. An ICO is beyond the control. An ICO is beyond the control. It is possible. It is possible. Listen, sometimes we offer things and public just run away. There are IPOs hard, which are badly undersubscribed. Yes, we have seen big IPOs are undersubscribed in the end. So it is a possibility that in the end the conditions change because the economy is economic. There are a lot of economical changes. We have seen in COVID. We have seen in COVID the high demand, high ups and downs in stock market and everything. Recently, if you are watching the stock market, you can see there is a 25%, 20%, 25% drop in FANG stocks. Go check Netflix, Facebook, all stocks are down. So things are quite uncertain in COVID time. And this is the product of COVID time. If you see, this is the product we are talking about. This is a current issue topic. This is basically a current issue. This thing is happening right now in the world. Okay, so this transaction at 31st March X7, at the year end, this is a liability. Okay, see the final implication. At 31st March X7, the $1 million is viewed as a financial liability in accordance with financial instrument C, bank debit or financial liability credit. Now what about the next year? Wait, what about the next year? Next year at 30th April X7, next year at next year at 30th April X7, when you receive 10 million at the time of token, at the time you issuing the token, you will make the entry debit bank 10 million and credit financial income. Sir, why income? Because there is no contractual obligation to deliver cash. these token are tokens are not redeemable, and you are not giving any ownership rights to the token holders. You are not giving any rights in the assets to token holders after deducting all your liabilities. So there is no equity, there is no loan. So finally the default number is income, PNL. Okay, so you will make the entry debit bank 10 million. You will make the entry debit bank 10 million. You will make the entry debit bank 10 million and credit cash 10 million. Debit bank 10 million and credit. No, wait, one question. Sir, why should we debit by? No, 9 million was the minimum requirement. My dear student, though the student who is asking this, sir, why not 9 million? 9 million was the minimum requirement 1 year back. At the time of initial, sale, it was the minimum requirement. You can receive any money. You can receive any money more than 9. It could be 10, 20, 30. It's your luck. It's your luck. But 9 million was the minimum target. Okay. Dear student, did you got? Oh, when we receive 1 million from those guys, we promise them that next year at the time of ICO we will generate minimum 9 million we'll generate. But what if it cross 10, 20, 30? That's a good luck. That's very good. Even that is better for the existing one. Even this is better for the existing guys because the deal is super it now. The funds paid by shareholders of token 10 million have one-off rights of one-off rights for this 10%, one-off rights for this 10% profit for the year ended 31st March X8, but they do not have right to the redemption or residual interest in the assets. Due to this reason, the company should not record inflows as a financial liability or equity, right? And but company should record it as an income. Okay, that's why I make the entry bank debit and financial income credit, because there was no obligation and there was no equity rights. Okay, now finally about the 10%, about the 10% profits deal. This is C, defines a contingent liability as a possible obligation depending on whether some uncertain future events. I told you the recognition of the liability depends on whether there are annual profits. Therefore a liability should be therefore a liability should be booked a liability should be booked if company gets confirmation of profits in the year ended 31st 31st March X8, right? That's it. Okay, now do you have this thinking in your mind? Did you develop this thinking in your mind that these tokens are not equity instruments of company? These tokens, coins are not equity instruments of company, and they are not even debt instruments of company. Especially they are not equity instruments of company. Did you establish this thing in your mind? If yes, then get ready for the same dodge. Get ready for the same dodge, please. Yes, see this. Read this: tokens granted to directors, or let me show you in the Word file. Wait. You can see this. See this. Come on, read it and then tell me your opinion in the chat box. Excellent. You can play now. Is it IFRS 2 or IS 19? Is this IFRS 2 or IS 19? This is IFRS. Yes, very good. This is IS 19. This is IS 19, not IFRS 2. Very good. We are providing benefits to employee. We are providing benefits to employee. You are very right. Very right. Now, let's read. Symbol company sometimes does not issue all the tokens from an ICO to investors, but retain some to use to reward their employees. On 1st March X7, symbol company granted tokens to its 5 directors from the issue on 30th April X7. See, 1st March X7, that means before that, our first accounting period ends on 31st March X7. Our first accounting period ends on 31st March X7, right? So this is 1 month before that accounting period. This is 1 month before that 31st March X7. Don't forget. Granted tokens to its five directors from the issue of on 30th April X7. The award vest, read this line, wait. The award vest on 31st March X7. The award vest on 31st March X7 to directors who are in Symbols Company employment at 31st March X7. That's it. That's it. That's it. That's it. See this. Those who are in employment at 31st March X7, they are eligible. See, the award vest means given, means confirmed on 31st March X7 to directors who were in symbol companies employment at 31st March X7. That's it. The tokens give the directors the right to receive a car. Director to right to receive a car of their choice up to a value of $50,000 at any time in the next 12 months to 31st March X8 if they remain a director of symbol company. All 5 directors were still with symbol company on 31st March X7. Listen, those who stayed, first of all, listen the word, those who stayed with us till 31st March X7, they have vest, their rights have been vested. That means they are eligible. They are eligible. So company need to book a liability. Company needs to book a liability for them. Now, the next question, which IS to be applied? Which IS to be applied? Is this IFRS 2? No, because as company has promised to give them tokens. These tokens are not the shares of the company. These tokens are not the shares of the company, and IFRS 2 clearly says if you provide shares of your own company or your group of companies or cash equivalent to the market price of your own shares, then it is in the scope of IFRS 2. So this is no more IFRS 2. So now you are providing a short, listen the word, you are providing a short-term benefit to your employee. What is short-term benefit? Hope you studied IS 19, in which the benefit which is to be provided to employees within 12 months, the benefit which is to be provided to employee within 12 months of the end of the reporting date, the benefit which is to be provided to employee within 12 months of the reporting date, within 12 months of the reporting date. So yes, you need to make the entry debit expense and credit current liability, credit current liability, because you have to provide within 12 months, you have to provide within 12 months, and this is a short term benefit, this is a short term benefit. Did you understand? First tell me. It's a non-cash benefit. Listen students, dear respected students, it's a non-cash, because you are not giving cash, you are giving a car. It's a non short term non-cash benefit, it's a short term non-cash benefit. Normally student, look at me, let me clarify you. For, if you are giving benefits to employee in the form of your own shares, if you are giving benefits to employees in the form of your own share, then you are getting service, this is IFRS 2. But if you are giving anything else, any other benefits to employees, any other benefits to employee, then it is IS 19. And now in IS 19, hope you remember, there are 4 types of benefits in IS 19. Think over IS 19: short term benefits, long term benefits. Did you study short term benefits, long term benefits, termination benefits, short term benefits, long term benefits, termination benefits, and post employment benefits? Remember, hope you have studied these 4 types. So now you have to decide which type is this. So this is the first type, which is short term benefits. This is short term benefits, and short term benefits are those benefits which you have to provide within 12 months of the end of the reporting period, which you have to provide within 12 months of the end of the reporting period. And why you have to book complete liability? How much liability you will book? There are 5 directors, and one director the liability is 50,000. There are 5 directors, and for one director the liability is 50. So 5 multiplied by 50, you have to book 250,000. You have to book 250,000. Let's check it. Wait. Okay, please go through this. Go through this. Now you have some knowledge. Okay, see, the ICO tokens fall within the scope of IS 19, fall within the scope of IS 19 employee benefit as a non-cash employee benefit. Okay, because the cars means non-cash. IS 19 can be used to determine the recognition as well as the measurement of employee benefit. It deals in all these type of employee benefit except for those who lies in the scope of IFRS 2. Now, the arrangement would not, clearly would not, this was the dodge, this was the quiz of the day, this was the turning point of the day. You guys forgot, I asked the quiz today 1 hour before. The arrangement would not meet the definition of a share based payment arrangement in accordance with IFRS 2 share, because they do not grant the directors a residual interest in the net assets of symbol company. That means we are not issuing our own shares. See the explanation, we are not issuing our own shares, and we are not issuing cash equivalent to our own shares. We are not issuing our own shares, and we are not issuing cash equivalent to the share price of our shares. So this is not at all in the scope of IFRS 2. Now, it is a non-cash short-term employee benefit. Why short-term employee benefits? See the detail. Short-term employee benefits are those expected to settle wholly before 12 months after the end of the annual reporting period during which employee services are rendered. Okay, now the arrangement includes a condition that the director should be in employment in at 31st March X7. So yes, all the five directors are still in the employment, at 31st March X7. So yes, it's an obligation, because yes, they have done their condition, they have fulfilled their condition, means they have done their work. So it's an obligation for us. Symbol company should recognize a liability and short-term benefit expense at 31st March X7 with the following entry, see these. The estimated cost as given in the question was 50,000. The estimated cost as given in the question per director is 50,000. So 5 multiplied by 50,000 is 250. Now, some final words for you guys. First of all, I would recommend you, now you have almost 20, no, not 20. This is a short month. So you have hardly now 18 days or 19 days, 18 or 19 days you have. Okay, so no need to watch complete lectures of IFRS now. No need to watch now the complete lectures of IFRS. If you want to watch the past paper lectures. Yes, you can watch the past paper lectures, plus now you are on the ending stage, you know a lot of things. See, you have studied, these 4 classes were too much, you have studied many things. Now at least give yourself some confidence that you know something. Don't tell yourself each and every day that you know nothing, otherwise your confidence you will have no confidence. It's simply, and you know you will you will start thinking negative, and you will start behaving like a failure guy. One thing, I have seen many families in my country, in my city, when a student joins MBBS, like a student wants to become doctor, and he joins any university, medical university. So their parents started calling them doctor from the first year or second year, right? Doctor this, right from the first year student, second year student. Right now the student is not a qualified doctor. Right now the student is not a qualified doctor, but their parents and their family members start calling them doctor. So this gives them, the student, confidence, thus yes, I can be a doctor. So please keep yourself, start calling yourself SBR qualified, start calling yourself SBR qualified, and even write this on the wallpaper of your cell phone that you are SBR qualified. So this will give you confidence. Okay, this will give you confidence. And one more thing, in these 18 days you can watch past papers, read the summaries. Today I sent you one file on the WhatsApp group. I sent you one file not made by me, but one of my student from Canada. One of my student from Canada, he made it. Very nice guy, last year he made it. So this is beneficial for all of you, and this is good for him as well, because if you pass, you will pray for him, you will pray for that guy. Okay, so I have sent you the summaries, plus I will send you more past paper recorded classes, more. I have many latest past paper classes. I will send you guys on the WhatsApp group, so be active. And also please read all the articles 2 to 3 times. Keep 3 to 4 days vacant, 3 to 4 days for keep 3 to 4 days vacant for your article reading. This is very important, especially the exam technique article. Read the mind of the marker article. These articles are very important. See, the question which I taught you, it's all present in the article. I'll share that article with you, and if you read it, you will see, you will say, sir, it's copy paste in the exam. So it's better you read the articles. Okay, and one more thing, see, these are last 15-20 days. In these days, avoid all other activities, avoid all other activities. Believe me, even I do the same thing. Listen to me, since last 10-15 years I didn't take any Sunday off. I work every day. I work every day, believe me. Even I don't go to my institute, but I work with my phone, because online teaching and online things are all connected to phone. And today is Sunday. Today is Sunday. Listen to me very carefully. Today is Sunday, as well as today is my birthday, right? And today I took 2 webinar sessions of 3 hours. In the daytime, I took one 3 hour session for TX, the taxation class, and this is SBR class. Plus I did 2 business meetings as well, and this is Sunday plus my birthday. But still I'm working, because I know this is the time of hard work. Yes, I can enjoy next week, or when during your exam week, I'll enjoy. Then you can see my pics. I will enjoy on these days. So try to understand that how to use time, how to utilize time. And I know personally, many students, believe me, they cleared SBR paper in 1 month. And one more thing, sorry, real story. In June 2021, I forgot the name of that girl. She is the Pakistan top position holder, nationwide position holder. I forgot her name, sorry. Believe me, she gave paper in June attempt, and she started studies on 20th April. I have her voice note saved in my phone. She asked me, sir, I'm starting on 20th April. Is it okay? I said, okay, if you work hard continuously, you are not doing any job, work hard non-stop, you will do it. And she scored nationwide position in just 30-40 days. So still you have a lot of time. You can score good, and you have a WhatsApp group now. You can share, you can help each other professionally, but be professional. Be professional in the WhatsApp group. Okay, so best wishes for you guys. Be confident, be confident. Don't waste your time. May you all clear this paper, and may you all clear this paper this time. Okay, take care. That's it for today's class. Bye bye.